Crude oil is oversold, hated, and left for dead. Exactly the recipe for a vicious short squeeze. Could oil prices be about to explode higher, catching everyone off guard? Let's dive into the trade. Welcome to another episode of The Long and Short of It. I'm Patrick Serezna.
And I'm Nick Galarnik.
All right, Nick. Last week or a couple weeks ago, we did that episode with Google and AMD. Boy, did they boom.
Yeah, both trades ended up popping over 100% within a day. So they've since come back down a little bit, especially AMD, but nevertheless, some more banger trades, and again, asymmetry of risk wins out again.
All right. Well, there you go. Listen, I want to, it's my turn. We're going to talk about a trade that I have going on. So let's dive into it. I'm going to go a little bit more macro as opposed to individual stock names. I'm going to do crude oil.
All right.
And so I have the chart here of crude oil. Let me throw on here a 50-day moving average. And what we basically have, this is the August contract, and we've had a pretty decisive downtrend in crude oil for a while, and it's been ugly, and it's hated. No one wants to talk about it. No one cares. Essentially, everyone is shorted, including all systematic traders. So when you're talking CTAs and other traders that are trend following in their nature, they're all forced to being short oil during this downtrend. Now, I'm not here to actually make a bull case. There is a bull case. We on Macro Voices had a great episode with Anas Alhaji talking about why longer term fundamentals could change. But my actual thesis is based upon the nature of liquidity flows and market positioning, which is that when enough traders are all on the one side of the trade, inevitably the market seeks the pain trade, which is
Yeah.
to literally go the opposite direction. And what it creates is a positive feedback loop or negative feedback loop, whichever way you want to look at it, of short sellers having to cover. Looking on this chart, the last time we had an event like this was back in September, October, where just in a span of this was 8 days, the oil market ripped about 11, 12 percent, or about $8 on the upside, and it was a $10 move off the September low. So when oil was beaten down and the short squeeze begun, an $8 to $10 advance on the upside is actually par for the course. This is the way short squeezes work. It has at some point, if it ends up being a major bottom, some fundamental reasons start to emerge after the fact, Nick. Now, rarely at the market bottom when it's trading the cheapest are there the fundamental reasons for oil to be going higher. So this is a pure speculation on the fact that this is due for a pain trade on the upside.
Absolutely, yeah. And I mean, like the macro climate kind of supports your thesis a bit in this regard. Also, because when you think about it, the Supreme Court just halted, Trump's tariffs. So if that holds up, which it may not, and he may find some way around it, but if that holds up, then all of a sudden commerce is going to be flowing again, which means that oil will be flowing again as well. And as a result, that should also pressure prices to go a bit higher back to that, 70, 75 area again, possibly pretty
Right.
fast.
All right, so let's just look at a couple technicals, and then I'm going to set up a trade.
Sure.
Okay, so let's first of all, what we have is technically a double bottom, a key bottom retest. As what we saw was crude oil went and retested its previous low. Now, what actually validates it actually being a double bottom would be a legitimate breakout above all of the highs that were established in the middle of it. And so you have a scenario where the 50-day moving average and all of the previous highs are actually a key moment where if this was bullishly broken out, it could start that bullish chain reaction of short covering to really drive that upside squeeze. Have we seen it yet? No. But if we don't see the market weaken all the way to the downside and this continues to develop as a basing formation, there is room for this setup, and nobody's watching because nobody cares. All right, so the idea for me is this. I could have come on here I said we could buy crude oil, we could buy an ETF on crude oil, we could turn around, buy energy stocks, we could buy a call option on it. But I wanted to demonstrate the idea of how to play a little lottery ticket on this, where you don't have to outlay a lot of money and have an opportunity for an extraordinary payoff. Now, we have talked about using bull call spreads in prior episodes, but what's particularly interesting for me is the fact that we can get an amazingly cheap and attractive payoff profile on making a bet that a short squeeze can happen. Short squeezes happen very rapidly. Think of what the
Hmm.
S&P 500 did after that short-term low,
That was
right?
insane.
Like that was insane. It was a rip. When the short squeezes happen, they happen fast.
Hmm.
There's no short-term little thing about it. And so in my mind, we could get a move that is $5 to $10 on the upside if it happens, but it may not happen. So I want to make sure we're outlaying a small amount of capital and leaving the opportunity for extraordinary gains. And so the way I have here just a quick IB account up here. I want to just quickly look at doing a bull call spread between out to the on the August futures contract between the 68 to $70 area. Now, the expiration on this option is in the middle of July. This has got about just under 50 days on it at the
Hmm.
time we're doing. And so, just to show it on the chart, we're talking about a spread up here in the 68 to $70 zone, quite a distance away, more than 10% of a distance away. This is why the deltas are so small and the options are so cheap, because
Hmm.
on balance of probabilities, this is still quite an outlier to actually reach those price levels. So right now, that $68 call option is asking 78 cents against a 55-cent bid on the 70-cent option. So we're talking about just under 25 cents in order to put this trade on. And so in my mind, this is simple. We put out, whether it's 20, 25 cents, wherever you get your fill prices on that for a $2 value. You've got basically a buck 75 upside potential on this trade if it comes to fruition.
Hmm.
But even then, just like when you trade spreads, like even if oil just popped to 65 bucks, this thing's going to be up 100 or 200% as that spread will quickly go to 50 to 75-cent value on the upside. And so to me, this makes this a really interesting way to play this, where you can just put a small amount of capital at risk and have a little lottery ticket that lasts it's almost 2 months, just under 2 months in time, and you have a real chance of catching one of these squeezes on the upside.
Absolutely. I mean, from my perspective, like what I would do myself, like again, like you and I both have different perspectives, obviously,
Yeah.
but I would use like a oil co like XOM, for example, ExxonMobil, and looking at the chart on that right now, the support on the 2-year chart is like 95, very heavy right there, 95. Even during the recent crash, so to speak, we're at like 98 bucks. Now we're at
Yeah.
102. But I think if what you're saying transpires and prices go back up to that 70 area, we're going to see a bounce probably up to like, 110, 115 on XOM. And so what I just found right here, looking at my options chain, is the July 18th, similar expiration to yours, 110, 115 call spreads at a debit of 70 cents. And if you want to go one step further and perhaps be a little bit more cavalier in your approach and take a bit more risk, but also have a lesser probability of losing, you could also sell, for example, the 95 to 90 credit spreads for the same amount of cash. So basically,
Yeah.
you have a free position with downside of like $500 if it goes below 95 to 90, which is improbable given that we haven't seen it go below 95 in the last 2 years. Whereas upside there would be $5 per spread from 110 to 115. So, like in that scenario, you have between like 105 and 95, zero loss, nothing happens. Below 90, max loss $500 per contract, right? Above 115, maximum profit $500 per contract. It's kind of like a interesting way of kind of like hedging your bets in a way, but also having a defined outcome on the downside and upside with high probability of upside.
Oh, see, I'm a little bit more of a player than you. You're doing it with a credit spread.
Yeah,
See the
yeah.
sign right behind here? What
I
is this?
know.
Let's get some
Naked
naked some
puts.
puts,
Yeah,
because what I would be doing personally is right now on that crude oil trade that I was looking at, the $45 put option out to the same expiration is paying you close to that same 25 cents.
there you go.
And so for me, I'm more than willing to actually buy in a crude oil futures contract if they're going to give it to me at $45 a barrel on oil, right? And so for me to sit there with a put option that's time decaying down there, that just paid for your bull call spread on the upside. So whether you do it as a credit spread like
Yeah,
you're suggesting, or whether you do it naked the way that I would commonly do, those are just ways to offset the costs, to
yeah.
help with the carry cost of carrying the trade. That's anyway. That's my idea. But any last closing ideas or thoughts that you wanted to say, or we'll wrap?
No, as always, manage your risk and keep in mind that over the next month or so, we have a lot of U.S. debt maturing, and that rollover with new bond auctions may cause a lot of volatility in the short term. So by
Yeah.
the June OPEX, we might see some decent dips on the basis of that, what I just said.
All right. Well, have a great trading time, everyone.